Welcome everyone. My name is Nikki Johnston and I'm with Transition Advisors. Our webinar today is Case Studies on Internal Succession. Before we begin, we need to cover just a few important items. First, please close any other programs that you might have running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. Under NASBA guidelines, today's 60-minute session will qualify for 1.2 CPE credits. Terry, could you show the next slide, please? In order for you to receive your 1.2 credits, you must complete two requirements. The first is that you participate in all 4 of the polling questions throughout the presentation. Please note that GoToWebinar does monitor your participation in these polls. We will be able to issue partial credit for those who answer 3 out of 4 of the polls. The other requirement is that you complete an online evaluation. This will appear on your screen immediately after our webinar ends, so please take a moment to complete that before you close your browser. Once you've met both of the requirements, I will email your CPE certificate to you within 10 business days. Now, in order to fully participate in the webinar, please take just a moment to familiarize yourself with the GoToWebinar control panel. It should be on the right-hand side of your screen. There's an orange arrow near the top. You can use that to minimize the control panel. During the presentation, all participants are muted, but you can communicate with us by using the question box toward the bottom of the panel. Just type your question there and click send. Terry's encouraging lots of questions today, and he'll be answering them throughout the course of the presentation. Terry will also be sharing his webcam during today's presentation, and you are welcome to resize that, minimize that, even close that if you wish. Finally, I'd like to remind you that Transition Advisors offers a free CPE webinar each month. We have just a few more sessions left before we take a break for tax season. It looks like the one
wrong slide here.
Wrong slide, yeah. So we have a session in November, which is on the 9th. That's called Keys to Due Diligence and Client Retention. Joel Sinkin will be leading that. We also have one on December 14th about admitting new partners. That's another one that Terry's leading. You can find both of those webinars and register for them at our website, which is transitionadvisors.com. Now I'd like to go ahead and remind you that you did receive a link to download a PDF of the slides. That was in the reminder email you got from GoToWebinar. I also sent that via the chat function, so you can download that there. If you're having any troubles or would like for me to email it to you as an attachment, just send me an email. You can reach me by replying to any of those emails that you got from GoToWebinar. Now I'd like to go ahead and introduce our presenter for today's session. Terry Putney is the CEO of Transition Advisors. Thanks so much and enjoy today's webinar.
Hello, everyone. I'm just trying to get my video here to where I can see the slides. So here we go. Okay, so I apologize for the incorrect slide that Nikki made reference to. That was my fault. She sent me an updated version of the deck, and I unfortunately pulled up the wrong version. So first, let me just introduce you to Transition Advisors. We are a national consulting firm. We work exclusively with accounting firms, almost all CPA firms, and all we address are issues related to ownership of CPA firms. So that falls in 3 different categories. A majority of what we do involves supporting and arranging mergers and acquisitions of CPA firms. We can support deals that you find on your own, or also deals that we find for you, as well as if you're in the mood of an upstream merger, of course we can help you find a solution for that as well. We work with owner agreements, and that's going to be the sort of the topic that we're going to be addressing here today, and also general succession planning and other types of practice management associated with the ownership in a CPA firm. We got a lot of, in past webinars, we've received a lot of requests for real live case studies of situations that we've run into. We oftentimes refer to case studies in our webinars, but a lot of times they are composites of different projects that we've been involved in. In this case, we're going to go through 3 actual engagements that we were recently involved with. I think they represent a good cross-section of the types of situations that we run into. The first is a small sole proprietor that was admitting a new owner for the first time. It's a good example not only of how to deal with a sole proprietor situation like that, but also how to admit new owners in any firm. The second one is a larger firm where the thing that I think makes this an interesting situation is that, in my opinion, the agreement, some flaws that were in the agreement were actually creating some operational issues within the firm, and correction of those flaws will hopefully lead to better performance within the firm. And then the third example is a little bit larger firm that is moving away from a majority ownership by one partner who was the founding partner in the firm, and the firm has grown substantially since the firm was founded by him. But now we're in a situation where as he gets closer to retirement, we need to move to an entirely different governance system and tweak the allocation and determination of value amongst the partners in the firm. So I think you'll find that interesting as well. Just to give you an idea of kind of how this process works and how we reach the conclusions we did in each of these cases, I thought I'd walk through kind of what the steps are in this kind of an engagement. The first thing that we do is obtain, financial and operating data on the firm, and also all of the key constituents, which are normally at least the owners. We also oftentimes include anybody that's not an owner that is soon to be an owner. So the kinds of information we're looking for, of course, are the ownership, the compensation, how much business the person's managing, how much new business they're bringing in, what kind of productivity they have, what their succession plan is. How long will they keep working, and other information that's necessary for us to get a full understanding of each individual's situation and the impact that's going to have on the firm. We then go through first an interview with the management team, which normally is at least the managing partner, and to try to develop an overall understanding of what he or she sees the issues are, and also start talking about how some different alternative approaches that we might use to address their issues. Then that leads to an interview of all the owners in the firm, as well as sometimes the owner candidates. And the idea of these interviews is to make sure that we get a perspective of what each person's beliefs are as to what the issues are, what their personal beliefs are, and how any changes might impact them. But it's also an opportunity to start talking to them about what the solutions might be, so that we can uncover where there might be some resistance to what might come up as a solution, and hopefully create a better consensus when it comes time to make decisions about changes. Circle back with management with, again, the high-level recommendations, and then that always results in a detailed written report to all of the owners with all of our recommendations. And so I'm going to go through with you in each of these three cases, what the situation was and what the recommendations were that we made in each case. I know it's kind of early for this, but we have to go through 4 of these, so I'm going to turn it back to Nikki for the first question, polling question.
Okay, thanks, Terry. The first question is on your screen there. This one is pretty easy. How many equity partners do you have in your firm? So I'll give everyone just a few moments to answer this first question. As Terry mentioned, we will have 4 polls throughout the presentation today, and all 4 are required to get the full 1.2 CPE. Okay, and nearly everyone. I'll go ahead and close and share the results there. Half of the folks on the call are in that 2 to 4 range. 42% just have 1 equity partner, and then we have 8% in the 5 to 9 partner range.
Okay, that's a good mix for what we're going to talk about today. So again, we're back to the sole proprietor. This person has, the data in this situation is fairly normal for a circumstance like this. It's a $1 million firm with a 38% profit margin. Sole proprietor is 52, so he was fortunately way ahead of the game. Unfortunately, a lot of times people come to us and they're kind of a little late in the game in terms of trying to deal with succession. But in this case, he was still young enough that we had a lot of time to execute a succession plan for his firm. The firm is an S corporation, which makes a difference, a key difference here that we'll talk about in a minute. The billable hours for the owner are a little bit high, and you might wonder why that's important. I'll explain that in a few minutes. Receivables and WIP are about normal for a firm this size. Again, that's a component of the value, so that can be an important issue if it's out of line. And the shareholder candidate that's being considered for admission was 44 years old, so it's important, again, that that person's in a position where they can actually execute a long-term succession. Other information we determined was that the owner wants to retire in about 10 years. The manager had been with the firm for about 10 years and was considered a really good candidate to replace the owner, and we did a little bit of due diligence on that to make sure that was the case. Oftentimes we're just relying on management's decision as to whether or not people are actually in a position to replace the owner, but there are times when we'll find out that they're maybe kind of pushing the envelope too hard and this person really isn't up to the task. What we needed to do was develop a buy-in plan for the new shareholder. We need to develop a shareholder agreement for them to use and a buyout plan for the existing owner. Now, why was the shareholder agreement important other than for the obvious reason of developing the buy-in and buyout plan? One of the things that we run into frequently in firms this size are the lack of any kind of agreement. And I'd point out that a handshake agreement obviously might work if everybody is still in the same mood when the handshake was done, but oftentimes, if we're running into an unplanned type of termination like a death, disability, a divorce, something like that, we're leaving up to lawyers or other people who may not have the firm's best interest in mind to negotiate a deal that should have been negotiated in a written form. So if you have more than one owner in your firm, it's really critical that you have some form of owner agreement, or otherwise you're really taking a significant risk. So in this case, we were able to justify a one-time fees valuation metric for the intangible value. I'll go through our analysis of that justification in a minute. But I think most firms of this size have an expectation that their internal value should be about 1 x fees. And it's pretty common that they will be. The surveys that are done on this would indicate that the smaller the firm, the more likely they are to use a 1 x fee valuation. As firms grow in size, we're seeing a trend towards less than 1 x. Very few firms nowadays are over 1 x fees. So in this case, I'll show you why we were able to justify using that. The other component, significant component of value when you're looking at the overall value of an accounting firm is the tangible value, and that's basically the accrual basis equity. So in this case, going back to what I talked about earlier, that's about $300,000 of accounts receivable and WIP. And so what we're looking at is separating the value into 3 buckets. One is the cash basis value, which we're going to assign to the stock in this case, the remaining tangible value, and then the intangible value. So in this case, with a $1 million firm with $300,000 of receivables and WIP, we're looking at a total value of around $1.3 million. Another issue to consider here is that oftentimes in these smaller firms, there's sort of an assumption that possibly the transaction should be outside of the corporation between the individual owners. This happens, for instance, when we have maybe a 2-partner firm where one of the partners is retiring and the specific individual, or sometimes a group of individuals, are identified as the buyer of that interest, and the other partner isn't interested in being involved in that buyout. They sometimes have an assumption that maybe we should do this outside the corporation or partnership, and there's a lot of reasons why you don't want to do that. So most always it's better to put the transaction as a part of the, have the corporation be a part of the transaction. It doesn't mean you can't specially allocate the cost of the buyout to individuals, but you really want to do it within the entity. So in this case, the plan we came up with was to sell 20% of the outstanding stock based on the cash basis book value of the company over 5 years. So the new owner would buy, in essence, 4% stock of the stock each year for 5 years. And then we would also require that that individual invest in buying 20% of the tangible value of the company, which was the receivables and work in process, which would amount to about $60,000 in total. That would be done through compensation adjustments, so that the stock would be acquired by just writing checks, and then the rest of the tangible value would be acquired through a compensation adjustment. What we didn't require, and very rarely do require in these plans, is that that new shareholder acquire any of the intangible value, or the $1 million of intangible value, and I'll show you how that works here in a second, why that wasn't necessary. But in essence, that intangible value would be acquired by that new shareholder through long-term, through participating in the growth of the company, and then by eventually buying out the existing shareholder. In this case, we were able to use a tactic that works sometimes in situations like this, and that was that we had the current shareholder sell his personal goodwill to the company for 1x current fees. That allowed us to get capital gain treatment on the sale of the $1 million of intangible value. Now, in order to do that, we had to meet 2 tests. One was the requirements of the Martin ice cream case, which you may be familiar with, which has to do with determining when personal goodwill is owned by an owner of a corporation as opposed to the corporation itself. Because there wasn't any kind of employment agreement in place between the current owner and the company, until there was an employment agreement in place, which would have happened once we signed the new shareholder agreement, we could say that the current owner actually owned the personal goodwill. The second test we had to meet is a lot more complicated, is the anti-churning rules under section 197F9, and we were able to meet that test as well. So in this case, we were able to overcome the problems you have transferring ownership in a corporation, because normally either you have a non-deductible transfer of stock, or you have a ordinary income treatment as opposed to deferred comp, and neither of those really is a very tax-efficient way to transfer ownership. The additional value that the company that would be created once the partnership was formed would be shared equally. That was something that the existing shareholder felt was important. And the tangible value of the company would be based on stock ownership. So here's an example of how that would work. Let's assume that the company grew to $1.5 million after they became partners, and at that point had a $400,000 tangible value. How would that be allocated? Well, once the new shareholder had acquired 20% ownership, then the stock, the cash basis, would be allocated 80-20. The personal goodwill that was sold to the company originally by the current shareholder would always be held by that shareholder. So that's the first $1 million of a remaining value. The remaining $400,000 of tangible value would also be allocated based on stock ownership, and then the new intangible value that is the result of growth would have been shared equally. So you can see where the new shareholder accumulates his ownership, and how the current shareholder retains what was there once they became partners, but how the new value was allocated. So the personal goodwill payments would start at retirement. They wouldn't start now, even though the sale technically happened at the date that the shareholder agreement was signed. So that would be 10 years down the road. So we basically have an installment sale transaction that has a somewhat contingent starting date. Both the personal goodwill and any deferred comp would be paid over 10 years, and there wasn't any interest paid on on any of the payments, even though it would have to be imputed on the personal goodwill. We used a unit system for allocating the intangible value. That means that we decided that, or we assigned 1 unit for each dollar of revenue in the company. So that would be a 1.5 million units if we became a $1.5 million volume. However, there was a credit against that for whatever was allocated to the personal goodwill. So in the case of that $500,000 in growth, there'd be a net additional 500,000 units. We created a vesting program for the new shareholder, which was designed to keep him in place beyond the retirement date of the current shareholder to make sure there wasn't an early exit. Can't make somebody work, but we certainly don't want to encourage them through a financial reward to leave early. Also instituted a 2-year notice requirement for any termination so that there would be enough time for a proper transition of client relationships and other responsibilities. We included a 2-year professional non-compete, meaning that if either of them left the firm, they'd be unable to compete within the market area that they worked in for 2 years. And then there was a 10-year restriction on taking any clients from the firm. And then we also helped create a simple compensation plan, which was performance-based, which was based on personal productivity, growth in your managed clients, client retention, and practice development, and then some assignment for administrative duties. Here's the affordability test that I've made mention of. So if you recall, the current shareholder was making about $380,000, including benefits, currently. The first thing we have to do is replace that person's, at least recognize the labor necessary to replace their productivity. So as you'll recall, I mentioned that I thought 1,600 billable hours was pretty high, and it is. It's above average for an owner of a CPA firm. And in this case, we decided that replacement cost to replace those billable hours was going to be about $160,000, which meant that he was producing roughly $400,000 in billable time. The payment plan for the personal goodwill acquisition would have been $1 million over 10 years, so that's $100,000. And the payment plan for buying out the tangible value would be about $25,000 a year. So the net residual cost, or net residual after the costs that will go out for replacement costs and the buyout, would be about $95,000. So that's an indication that we've got an affordable plan. It's self-funding. It's not necessary for the company to borrow any money or for anybody to take a cut and pay in order to go through the payments. I would call this probably about minimum in terms of what we would shoot for residual value in any situation. Hopefully we get a little more than that, but it's sometimes difficult to beat that when you're dealing with a complete ownership by one person in the firm. So that takes us through the first case. Nikki, I'm going to turn it back to you for another polling question.
Okay, thanks, Jerry. The second polling question is on your screen. This one is, does your firm have an owner agreement? So your options here are yes, and it's signed by all owners. Yes, but not everyone has signed it. No, and you realize you need one, or no, you're not sure that you need one. This is our second of 4 polling questions. I'll give you just about 10 more seconds. If you haven't voted yet, go ahead and select your answer, please. Okay, looks like that's nearly everyone. I'll go ahead and close the poll. The results are on the screen. 44% say yes, and it's signed by everyone. 31% aren't sure that they need one. 25% say no, we do need one.
Okay, good. All right, so we'll go to the next case now. This is a very interesting case. It's a good firm, about a $9 million firm with 10 shareholders. Not a real significant succession issue with this firm. That wasn't really what was driving their need for us to take a look at their agreement. That's oftentimes is the case, but not in this case. But I think what everyone would agree, at least within the firm, and certainly I agreed, was an underperforming firm. You know, the net income per partner was only about $270,000, which is pretty low for a firm this size, and I think is the result of some flaws that they had in their agreement, and they recognized those flaws. The firm operated as a C corporation, which, you know, if you're a C corporation, I got to tell you, is the most difficult to work around in terms of any kind of transfer of ownership. It really leaves you with the least flexibility. When it comes to the issues that we deal with in an owner agreement, a partnership form, whether it's an LLC, LLP, or just a general partnership, is by far and away the most flexible. It gives you the most flexibility in terms of tax issues. An S Corp is slightly better than a C Corp, but a C Corp really kind of hems you in. In this case, the receivables and WIP were at a reasonable level. What was really a remarkable problem here was the amount of debt the firm had. It was about $1.5 million, and it was the result of the firm having borrowed in prior years in order to sustain partner compensation. As the firm went through some difficulty with profitability, instead of the partners basically bearing the brunt of that problem, they borrowed money and just had never paid it back. So this created a pretty big problem within the firm financial statements. One of the shareholders was already in transition, and one was due to start transition in about 3 years. So as you can see, succession wasn't a huge problem in this case. What we found in our interviews of the owners was that the shareholder agreement was deemed to insufficiently value the firm, and the allocations were not working. And I'll get into what the underlying problem was with that in just a minute. There was one of the shareholders had a specialized skill which was important to the firm's operations, but was the only shareholder that had that skill, and there was no succession plan for that person. So once they left, there was going to be a significant drop-off in the services that shareholder provided, which created a unique succession issue within the firm. And there was just an overall dissatisfaction within the ownership group of the agreement, the succession plan, the profitability of the firm. There just was kind of a malaise that hung over the entire firm, and I personally felt like the agreement was a big part of that. So the problem was that in this situation, in an effort to be conservative, the value of the firm was limited to the accrual basis book value. Well, remember, if you go back to what that was back here, that accrual basis book value was $2.4 million less than $1.5 million in debt. So it was only $900,000. So we're valuing, in this case, a $9 million firm for $900,000, which, needless to say, is substantially below what most firms would value a $9 million firm at in their owner agreement. The value was allocated to the owners on somewhat of a unit type system, what I'm calling a lockstep system. What that meant was that every year the firm reached a new valuation based on its net accrual basis book value, and whatever change was made in the allocation was allocated. That change was allocated to the owners on some basis, but what they'd accumulated up to that point they retained. And you know, that system can work when you've got ongoing growth, but in this case the firm had not seen any ongoing growth, and certainly none in the book value. So what we found was that only 2 owners held almost 100% of that, even though it was a measly valuation, almost 100% of that valuation. So we had, you know, I believe 4 or 5 owners that had no value at all allocated to them, and the other 3 or so had a very minimal amount of value allocated to them. To their credit, the agreement did call for a one-person, one-vote, equal equity ownership. So each of the owners did have equal stock ownership and equal vote in the firm affairs, but there wasn't much of value there. So what happens as a result of that is that basically the value of the firm is irrelevant to most of the owners, and therefore what normally works to help drive performance within the ownership group, which is an expectation that if we do well, I personally will benefit from that, wasn't resonant in this case. So the tool that an owner agreement can be used to drive performance basically wasn't available to the firm in this case, and I think it actually resulted in poor performance within the ownership group. So our recommendations were that first, that we convert the accrual basis book value to the stock value. So because it is a corporation, we do need to assign some value to the stock, and they had what I didn't mention was they had a minimal nominal amount of value assigned to the stock. I think it was $1,000 or something like that for the stock. So we converted accrual basis book value to the stock value, or recommended that. And then we suggested that they adopt a deferred compensation system, which would be based on 2 times average compensation paid over 10 years. 2 times in today's market would be considered at the low end of the relevant range. I mean, I've seen lower, but for the most part, the vast majority of firms that use that type of valuation metric are between 2 and 3 times. In this case, in order not to load the firm down with too much of a significant increase in potential buyout value, we suggested using 2 times. And we were able to justify that in our analysis, which I'll go through in a minute. We felt that the debt that the firm had was really an anchor on the firm and really was a problem. You know, there was 2 ways to pay off that debt. One would be to earn your way out of it, but in order to pay off $1.5 million in debt, you'd have to do that with after-tax dollars, which means that the firm would have to earn roughly $2.5 million in earnings, which would be, in essence, compensation that would be foregone by the owners, and for the most part by owners that probably had nothing to do with the debt being incurred. So, you know, there was a real problem, I thought, with trying to do it organically. So as a result, I suggested that the firm try to raise that capital from the ownership group and do it by, in essence, offering as much interest, return on investment as it took to get the capital. So, you know, if you look at it and say, gee, if we pay you 8 or 10% on your investment, that probably would be enough to attract a significant amount of capital to the firm. And what I also thought was important, though, is that we not change the governance system as a result of that. People shouldn't be able to buy their way into control of the firm. So this would be more of a pure investment as opposed to anything that would change how the firm was governed. I got to tell you that recommendation wasn't exactly met with acceptance by the upper management of the firm. I don't think that they actually implemented that, but I still maintain that was the way to go. And then we also felt like there needed to be a special provision in the agreement to deal with the exception that was created by the specialty shareholder who had no current replacement within the firm. The problem is that we had 2 managers that were also involved in that area of the practice, but there wasn't a consensus that they were ready to be admitted as shareholders. So in order to sort of force the issue, I felt like they needed to be realistic about the fact that if something happened to the shareholder at this point, there was going to be a loss of business, and that loss of business probably should be reflected in that shareholder's buyout value. So we suggested a special retention agreement for that shareholder's interest until they were able to overcome the succession issue that was placed on him. So that would hopefully force the issue and get them to put a succession team in place for him. We also suggested, feeling like the firm was probably over-partnered, which was part of the reason why their profitability was low, that they not replace the first 3 line partners that retired, other than the one that had the specialty practice. And again, that was something that was not in the agreement, but just a recommendation for their business plan with respect to succession. We felt like they probably should try to move to more like $1.5 million or $1.6 million of revenue per partner from the current $1 million. And then finally, we recommended that they adopt a mandatory retirement age of age 65. This is a really controversial issue within the profession right now. On the one hand, we are seeing an increase in use of mandatory retirement ages. It's not at 100% by any stretch in any segment within the profession. Even some of the largest firms don't have it. But you know, on the one hand, without a mandatory retirement age, you're basically flying blind. You don't know when people might walk in and say, okay, I'm ready, it's time to go. You have a hard time dealing with partners who are hanging on. But on the other hand, there's a lot of pressure on a lot of firms to find replacements for the partners that want to leave, and instituting a mandatory retirement age, of course, makes that pressure even greater if you're having trouble finding replacements. So it's something you've got to deal with on a case-by-case basis. But in most cases, we usually recommend that firms do consider instituting a mandatory retirement age. In this case, we felt like because there wasn't really a succession issue in place in this firm, they could probably accommodate it. So here is the analysis that we did that justified the financial terms within the agreement that we suggested. Again, the average shareholder comp, including benefits, was about $300,000. So that's the capital that you have available to accomplish 3 things. And that first one is replace the shareholders. In this case, personal productivity of the shareholders wasn't that significant. So the replacement cost for their labor for billable time was only about $120,000 per shareholder. The stock buyback, which we suggested should be done over a 5-year period, would be about $20,000 a year. And the deferred comp, which again would be based on 2 times average comp paid over 10 years, would be about $52,000 a year. So that leaves a residual of about $108,000 for the first 5 years and $128,000 after that, which we felt was within reasonable and indicated that the plan was self-funding and therefore affordable. That takes us to our 3rd polling question. Nikki?
Okay, thanks, Terry. The 3rd polling question is on your screen. This one is, how many partners in your firm will likely slow down over the next 5 years? Is it none, all, most, or some? This is our 3rd out of 4 polling questions. I'll give everyone about 10 more seconds. If you haven't cast your vote, please do so now. Great, thank you. I'll go ahead and close the poll. The results, they're there on the screen. Half of our attendees say none, 31% some, 13% all, and 6% most.
Okay, this takes us to our 3rd case study. This is an interesting firm. The firm has had significant growth over the years. It was founded by the managing partner not that long ago. And, you know, this managing partner, you know, when they founded the firm, which was mostly based on a book of business that he brought with him, you know, he retained a 65% ownership stake in the firm and had a partner that brought some business as well that retained a 23% ownership stake. And so between them, they had, you know, obviously almost 90% of the ownership. There were 9 partners, though, so 7 partners were splitting up the remaining 12%. And, you know, in this case, ownership didn't mean very much in terms of financial rewards. What it really meant was control. The managing partner was, pretty much a benevolent dictator. This partnership was taxed as an LLC, and I point that out because we do run in once in a while into LLCs that have elected to be treated as an S corporation, which, again, may make sense from the standpoint of annual compensation. I know it gives you the ability to distribute S corp dividends, which are not subject to self-employment tax. But when it comes to ownership issues, transferring of ownership and ownership agreements, S corps are a lot less tax efficient. So, my preference, since that's what I'm dealing with, is usually that we work with a partnership. There were no partners close to retiring other than the managing partner who intended to do so in about 4 years. As I mentioned, he ran the firm as a benevolent dictator. In my interviews with the partners, no one was dissatisfied with his leadership, with the way that he was managing the firm. Everybody was very happy with that. Their concern was what happens when he leaves, and that was also his concern. I used a closed compensation system. There are benefits and pros and cons to that, of course. We're finding that the pendulum appears to be swinging back. For a while, it was moving towards more closed compensation systems. I'm starting to see that less and less now. I can't say that I've got a very good, I look at a lot of firms, but I can't say what the trend is throughout the firm. That's not something that's typically in the surveys that we see. The transition to the new leadership system had to occur over the next 4 years because his intention was to be gone at that point. The firm was also actively seeking to grow through mergers, and the belief was that their current partner agreement might be a problem with mergers, and I agreed that it would be for a reason I'll point out in a second. And then there was also variance in the performance of partners, which is normally the case when you get to have 9 or 10 partners. Some are going to perform at a higher level than others. And the governance system that was in place, depended on the managing partner to make subjective decisions about how to allocate compensation and other benefits, but they couldn't rely on that going forward. So we needed to have something in place that would adequately address the variance in performance between the partners. The way their current agreement was set up was that it was at 1 times revenues, and they were already using a unit system. The payments would be made over 10 years. However, it left out any recognition of value for receivables. So this is where I thought there was a problem with respect to mergers, because in most mergers, in fact every merger I've been involved with, we're going to ask the acquired firm to contribute their receivables, or at least the like value of the receivables, to the new firm. And in this case, we'd be saying, yes, we want you to contribute your receivables, but you're not going to get any value in exchange for that. So packaging-wise, that would be a pretty difficult sell. I also thought that it left out of the value allocation an important component of capital that actually had been raised by the partners indirectly. I mean, receivables represents cash flow that future cash flow that partners or earnings that partners have created that hasn't yet been distributed. So it's important, I think, to recognize that asset. Other issues that we ran into was that the agreement only called for a 90-day notice period, which would be inadequate in terms of creating a transition plan for any of the owners. I mean, example I used, and I asked each of the owners this: can you imagine one of your partners walking in and saying, I'm retiring, I'm giving you my 90 days notice, and now you owe that person, without any contingency, all this money? Wouldn't you think that there'd be a problem with transition if that actually occurred? And each of them agreed there would be. There was also no mandatory retirement age. They had set up the agreement to allocate a third of the buyout to Section 736B1, which would create a capital gain treatment. In 2/3 to 736A1, the problem was the way the agreement was drafted, that wouldn't have worked. It wouldn't have resulted in what they were trying to accomplish. And there was a 250% penalty for violating the non-compete, which I believe would probably make it unenforceable. I'm not an attorney, but I deal with this all the time, and all the attorneys I've worked with would indicate that a penalty at that level could render the non-compete unenforceable. And then the other problem, which was really not a significant one, but I thought kind of an odd situation, was the deferred comp was vested after 10 years at 50% and remained at 50% until 20 years. So there was 2 very severe cliff vestings involved. The first one made sense to me, the second one kind of didn't. So our recommendations were that we leave the overall value at 1x by adjusting the intangible value to 75% of revenues, which actually is in line with what most firms this size are valuing their intangibles at within their agreements nowadays based on the surveys. The surveys tell us that the average is running between 75 and 85%. Firms, and the larger the firm, the lower the percentage tends to be. So we thought an intangible value at 75 was reasonable, but then recognized the tangible value, which previously wasn't recognized, and limit that to 25%. And what I was really trying to do there was to keep the valuation still at 1x in total, but break it down so that it made more sense, especially to merging firms. We told them how to fix the tax treatment so that we actually got the desired capital gain treatment on 1/3 of the payments. The other thing that they left out was all the steps necessary to avoid self-employment tax on the deferred compensation part in a partnership. There are 3 things you need to do to avoid self-employment tax. One is you have to make sure that the capital account is paid by the end of the year of retirement. And when we talk about capital accounts here, we're talking about what's on your tax return, so that's cash basis. That's usually not hard to do. The second thing you need to do is the partner can't be working for the firm in any year when they're trying to avoid self-employment tax. So, if you're going to have a partner continue to work on a part-time basis, then that's going to taint all the payments that year and make them subject to self-employment tax. But if they don't work, there's no reason why they should have to pay the self-employment tax. And the third step that a lot of firms miss is that payments have to be made over the lifetime of the partner. That doesn't mean we have to pay equal payments over the lifetime. What we typically see is after, say, a 10-year period during which the bulk of the payments are made, that maybe we pay that partner $100 a month for the rest of their life, or in some cases we'll take the 120th month payment and annuitize that over the life of the partner. So as long as there are some payments made over the lifetime, if you meet those 3 steps, you can avoid the self-employment tax on the portion of the payments that are treated as ordinary deduction. We also help them address how to form an executive committee made up of 3 of the partners, which would be the successor leadership team for the managing partner once he retired. So we put that in place now so that they could start transitioning over the next 4 years to a new leadership style. The other thing that we did, excuse me for just a second here, was we helped them address how to redistribute the value that was going to be acquired from the majority partner. He had 65% of the intangible value or the buyout value, and about 50%, or well, no, I'm sorry, it was 50% of the buyout value and about 65% of the voting shares. So we helped them go through a process of how to use a performance-based evaluation system for allocating that value back to the remaining partners, so that we achieved what I mentioned before was an issue, which was recognizing that not all the performance of all the partners was equal. Also help them install a more performance-based allocation of intangible units currently, instead of relying strictly on a subjective analysis by the managing partner, which was a fairly non-transparent system. Create more transparency and more feedback in those, so that the performance was actually being rewarded. People understood the cause and effect. And then laid out a plan for how to merge in new partners or how to bring in new partners. Our goal was to create, for partners being promoted internally, a buy-in of between $75,000 and $100,000 paid over time, so that they had some skin in the game. And that was something that we were able to do also because of the fact that we'd allocated, we recognized the tangible value of the firm through the receivables and WIP, whereas before, when everything was intangible, it was hard to set out a plan for how to create a buy-in for new partners. I'll turn it back to Nikki for our last polling question.
Okay, the fourth and final question is on the screen. This one is about your approach to valuing your owner's interest in the firm. Do you believe that it's fair and affordable? You think it's fair, but you're not sure that you can afford it? Is it not fair because it's too high or too low? Or does this question not apply to you because you don't have an agreement? Give everyone just about 10 more seconds. If you haven't voted, please do so. Okay, I'll go ahead and close the poll. Share the results. So 60% don't have an agreement, but 20% say they believe it is fair and affordable, and then the remainder are split evenly between the other three options.
If you're not sure about that, again, I've given you some tools here in this presentation you can use to do your own analysis of whether or not the plan you have is fair and affordable. And you know, it's a matter of assessing whether or not it's self-funding. I think that's the key to it. So let me go through just a summary quickly of some of the things that we find in owner agreements. You know, the equity method tends to be the most popular method that smaller firms use, and certainly the method that a lot of firms use initially when they first form. The equity method is, I own X percent of the firm, you own Y percent. We establish a theoretical value for the entire firm, which is oftentimes a percentage of revenues. And my ownership percentage times that theoretical value is what my buyout value is going to be. And, you know, initially when we come up with the equity allocations, they tend to make sense at that time. So, you know, let's say as an example, we form our firm and I bring to the firm a $500,000 book of business and you bring a $600,000 book of business. Maybe we set the equity at, you know, I've got 5 11ths and you have 6 11ths. And then down the road we admit a new partner and we decide, you know, to make it affordable, we're going to sell them a 3 or 5% ownership stake so that they can afford to buy in. It's not really that important because we don't use equity that much in the way we assign compensation. Well, then the time comes for buyouts, and all of a sudden we have a problem. We've grown from being a $1.1 million firm to a $4 million firm, and you know, my equity ownership, just like in my last example here, has grown, is now outsized relative to what value I really should be allocated. So the equity method, although it tends to work initially, tends to be a real problem down the road for firms that have grown substantially and haven't addressed a reallocation of equity along the way, which I find very few firms do. Your alternatives to that are either the compensation multiple method or the unit method. The advantage of the unit method is that it allows you to allocate changes in the value of the firm in a means other than, you know, what we currently own. The equity method kind of tends to just sort of, the math just takes care of itself. The unit method is a way of allocating growth in a way that's different than our ownership is. The advantage of the compensation method, of course, is that compensation tends to be a dynamic year-to-year evaluation, and so as my compensation grows, it also means that my contribution to the firm's value is probably increasing as well, so there's an automatic adjuster there. The trend that we're seeing with internal valuations is a downward trend in the valuation multiples. You'll see that in the surveys. I recommend the Rosenberg survey, for instance, clearly states from year to year what the valuation averages are, and the average right now is around 86% for all firms in the Rosenberg survey. That's just an indication, I think, that succession is a big problem for a lot of firms, and one of the ways to address it is to take some of the financial pressure off of buyouts. When you look at how to admit new partners, keep in mind that just like your equity has been acquired, or your value has been acquired through sweat equity, use the same concept with new partners, meaning when they first come in, there really hasn't been a lot they've done to increase the value of the firm, but over time they will contribute to the value, and so that's where I think the unit system or compensation-based system recognizes that sweat equity and helps them accumulate value over time. Other thing to keep in mind here is that the value of your firm is completely dependent on an adequate transition of the duties and relationships that your owners have. And so you need to make sure you've got in place a strong transition plan. If you want to see a generic transition plan, I don't have one in this presentation, but I can send you one. I'd be happy to do it by email. If you just send me a request, I'll give you my email here in a minute. And a generic transition plan for a retiring partner. It's really critical that you have that in place in order to sustain the value of the firm. And finally, make sure your buyout payments are affordable. Again, I've given you some tools in this presentation for assessing that with respect to your firm. Is this the right slide, Nikki? Or is this one out of date too?
No, that one looks right.
Okay, so these are additional webinars that are on our website. We actually provide a recording of every webinar that we do, and if you've liked this one and you want one of your colleagues to see it, or you think it would be helpful for a peer, another firm owner to see it, feel free to direct them to our website for that. There are these articles are also available on our website, which provide you insights into dealing with the value and transfer of value within an accounting firm. Finally, my partner Joel Sinkin and I had a hand in helping the AICPA create their Succession Planning Resource Center. I think you'll find what we did is not entirely what's on the website. There's other information there as well. It's a very good resource for dealing with succession planning in your firm, so I highly recommend you make use of that. I'm a member of the CPA Consultants Alliance, which is another, you can see here the other members of that alliance. You'll probably recognize some of these names. And I recommend that you, if you're looking for information about issues that accounting firms are addressing, even beyond what we do, that's a very good source, and you can sign up for our blog and for other information that we send out periodically at cpaconsultantsalliance.com. A book that we wrote within that group is available on Amazon for $150, and these are 3 white papers that we created that you can download. With that, I'll turn it back to Nikki. This is my email address in case you want to have any questions at all, or want a copy of that generic transition plan for a retiring partner. Nikki?
Great, thanks so much, Terry. So you see how you can get a hold of Terry there. If you have any questions that are related to your CPE certificate, you can reach me by replying to any of the emails that you got from GoToWebinar. You'll get another email in about an hour or so. That'll include links to all of the articles that Terry mentioned that you may find useful. Also, one more link to the PDF of the slides if you'd like to download them from today's presentation. As I mentioned earlier, there will be a survey that will pop up right after I close the session here in just a moment. So please do complete that before you close your browser. If you have any issues with it, again, you can email me and I'll send you a link that you can do at your convenience. Thanks so much, Terry. Thank you all for attending, and I hope you have a great afternoon.